Hello and welcome to Moneylife News and Views. I am Debashis Basu. The government, the RBI are worried about something. And that is there is not enough bank deposits. People are not investing too much in bank deposits relative to credit growth. So last week, Finance Minister Ms. Nirmala Sitharaman asked the public sector banks to make very serious concerted efforts, make special drives to ensure that deposits keep growing. By July end, deposits grew just 10.6% year on year, while loan growth was 13.7%. At this rate, the banks will not be able to lend anymore because there's a certain amount of ratio, the prudent ratio, to keep between your deposits and your lending. So that's bad for the economy if the banks are not able to lend more. And to ensure that the banks are able to lend more, banks need to attract more deposits. Now, the situation is quite bad because according to the Reserve Bank of India, the current account and savings account, CASA as it's called, it's a low-cost money for the banks. Now, the share of CASA in the bank's total deposits declined from 43% last year to about just 39% now. Now, before the FM met the bankers, about 10 days ago, she had pointed out that lenders need to focus on raising smaller deposits that come in trickles, but they are actually the bread and butter of the banking system. Again, the concern was the widening gap between growth of deposits, which is not much, but growth of lending, which is quite more. The question is, why are bank deposits not growing? In an economy that is growing at 7 to 8% GDP growth, and there is double-digit revenue collection from taxes, and also there is massive capital expenditure. The government is pumping money into the economy through a massive capital expenditure of about 11 lakh crore this year. Why is then the bank deposits not growing? The most popular theory is that savers are not taking their money out of banks and investing elsewhere. Apparently, this is especially common among the younger people who prefer riskier assets like mutual funds and equities. Nearly 47% of term deposits are now therefore held by senior citizens. Young people are not putting money in banks. The RBI Governor, Shaktikanta Das, has voiced the same concern, pointing out how alternative investment avenues have become more attractive to retail customers. Banks are taking greater recourse to short-term non-retail deposits and other instruments of liability to meet the incremental credit demand, he said. Now, this may expose the banking system to liquidity issues. You lend, but there's no money to back it. That's a big problem. Some reports indicate that the share of bank deposits to gross financial savings of households has fallen from 29% of its long-term average to just 29% from its long-term average of 33%, whereas the share of mutual funds has risen from 2 to 6%. Of course, some others think that this is a fallacy to say that money moving out from banks to mutual funds is ending up with less money with banks, because banks actually sit at the center of all financial transactions. If money leaves the banking system and goes as a subscription to mutual funds, then the same money mutual funds have to invest in shares, and when they invest in shares, they pay the sellers of those shares, and that money comes back into the banking system. Now, whatever, if you really want to increase the bank deposits, right, as the finance minister wants and the RBI wants, and obviously there is a genuine problem there, and what could be done about it? Now, pushing bankers, goading bankers usually does not get much results. Previous finance ministers, even a forceful one like P. Chidambaram, they all have failed to encourage public sector banks to keep more money in the bank deposits or lend them more. Now, public sector banks have their own compulsions. Fortunately, there is a simpler way to grow bank deposits, and that is to encourage a shift from a huge amount of money, almost about 15 lakh crore, which is there in debt mutual funds, sitting with mutual funds. Now, this shift is easy because over the past few years, the government's tax policies have made debt mutual funds much less attractive. In fact, there is no tax difference between debt mutual funds and bank FDs now. Which means that almost if the 15.44 lakh crore is sitting there, and at least 30 to 40% of that comes into bank deposits, that's a big relief for the banking system. Now, how to create this reverse flow from bank debt mutual funds to banks? What can be done to make this happen? There are three things according to me. One, there has to be incentives for savers. People actually have to redeem the debt mutual funds and put it back into banks. And this can happen if the ministry tweaks a little bit from the tax angle. There has to be a marketing campaign along the lines of bank Debashis Sahi Hai to pay back mutual funds in their own coin. Well, bank Debashis Sahi Hai, I'll explain to you later. And removing the mal-incentives for bankers who, doubling up as investment advisors, discourage savers from putting money into banks. Why am I saying banks Debashis Sahi Hai? It's genuine. Feature for feature, bank FDs today are better than mutual funds, better than debt funds. Now, the returns are similar, but when adjusted for risk, the returns are actually better. The interest rate and principal value of FDs do not fluctuate with changing market conditions. There's nothing better than bank FDs when it comes to safety. The principal is safe, at least in scheduled commercial banks, given how Indian banks are regulated. But the principal in debt mutual funds are not safe. They are market-linked. They fluctuate with the market. For instance, if you're holding long-term debt fund and interest rates go up, the value of your fund will come down very sharply. Now, over a long period of time, the returns are very, very similar. So it's not that the debt mutual funds are able to do something different or better than the interest you earn by keeping it in bank FDs. Most importantly, until 2023, debt mutual funds had a tax advantage. The tax benefit for long-term debt funds was eliminated by the same government, the Modi government, on 1st April 2023. So now debt funds are at par with bank FDs. This means that the returns are taxed as any other income of the investor. And yet, more than 15 lakh crore, as I said, is sitting in debt funds. They need a bit of nudge and pull. This money will easily shift with creative marketing campaign, as I said, but some tax benefit will make it even better. The only major difference today between FDs and debt mutual funds is that gains from the latter, which is debt mutual funds, are taxed on redemption. It's only when you redeem or you sell your debt mutual funds that capital gains arise, and therefore you are taxed. And you're taxed at that point. Until you sell, there is no tax. Whereas interest on bank FDs is charged on an accrual basis. You don't have to redeem. You made an FD, interest is accrued through the year, and you have to pay tax, whether you withdraw the money from the bank or not. Now, while conceptually this is correct, debt funds are capital assets. They lead to capital gains, so they have to be taxed differently. But FDs are income generating assets, so the income has to be taxed differently. This is correct, but since these are competing with each other, like to like, there is a case for creating at least a special class of FDs whose interest will be taxed only on withdrawal. Such FDs will allow a much higher compounding of income for savers because you're not paying tax on your interest, the money gets compounded, and if you earn more, the government's tax is also higher eventually when you redeem. It's a win-win for both. But there's a problem in this. So, banks are hotbeds of mis-selling third-party products, mainly traditional insurance plans, which have very, very low yields but give them big commissions. We have come across innumerable cases where a banker himself or herself encourages savers or deposit holders to put money from matured FDs into traditional life insurance product rather than renew the bank FD, because selling insurance earns the banks much more money than the money they would earn by you keeping the money with the bank. Even public sector banks have high targets for selling insurance to boost their profits. So if the finance minister wants to see the bread and butter of banks grow, tackling such mis-selling will help. It's about time this was done too, because mis-selling insurance has been continuing unabated for years, for almost 2 decades now, despite even protests for banks union themselves. So there you are. There is a 3-in-1 solution. You can cut out mis-selling. You can increase the deposits of banks, and eventually the finance minister also, or the tax department also, makes more money. Will they do it? Let's wait and watch. Thanks for watching this, and if you did like, please do share and do subscribe. Thank you.